So why do we look at the economic calendar? We use it to find high probability trading events. Now, on Wednesday, December the 4th, there was one high probability trading event we were looking at. It was the ISM Services PMI print out of the US. US service-driven economy, service sentiment is very important. And you can see here, we had this headline coming in below market's minimum expectations, that 52.1 print. And we saw the employment index 51.5 and the prices paid index 58.1. Now, what we were looking for on Wednesday was an opportunity to potentially sell the dollar on lower expectations of a 25 basis point rate cut from the Fed. So the cheat sheet that we were looking for, we were highlighting on that day. Let me just find that. Oh, there we go. We were highlighting this scenario here. If we saw a weak number, 54.0 or lower, we got that. And employment sub-index 52.9 low, we got that 51.5. Now, we didn't quite get the prices paid sub-index 58 or lower. It was like 58.2. However, you may have looked at that and said, okay, the headline is lower, the revisions are unchanged, employment sub-index is lower, revision unchanged, and the prices paid is very similar to the prior. So you might have looked at that and thought, okay, that does give us a green light for dollar-yen sellers, and that would be because there will be more chance of a 25 basis point cut, and that brought a bid into the bond market as a result. And just taking a look here at the dollar yen, you can see as the data released here at 3 o'clock on Wednesday, see the dollar yen sold off pretty steadily, really into one direction all the way down to the pivot point of the day, and then carried on a little bit past it as well. So that's why we're looking for these high probability opportunities. It's just areas where it's very likely that the market's going to move in one direction out of the data print, and it gives us these high probability setups. And we were expecting dollar yen sellers at market, and you can see that carried on for a good period of time after the actual release. Okay, as we look at the week ahead, these are the top 3 events. It's actually 4, but I put them under 3 headings, and there's 4 major things that are getting my attention. We've also got the Australian interest rate decision on Tuesday, which would be worth covering, but it's probably not one of the top events. The first event that's getting my attention is the CPI data on Wednesday. Now, the latest commentary from Fed's Waller last week said that he thought a December rate cut was still what he was leaning towards, but there was 5 data points that he was looking at before making the decision. One of those was JOLTS jobs, which came in fairly strong. And the next one to focus on is the CPI data. Now, what Waller wants to see, and we also had Fed's daily also sort of saying the December rate cut's not off the table. So the market's sort of been leaning more towards that rate cut from the commentary midweek. Now, this is before the non-farm payroll print. So if the non-farm payroll print has come out really, really strong, then this CPI print will be obviously very important. And it will equally be important if the non-farm payroll comes out very weak. It'll just be a question of where we are in terms of monetary policy expectations. So it's certainly a big event for us to cover, whatever the weather. The big picture is that CPI in the US has been dropping lower. Now, Fed members have been saying they're expecting it to be a bumpy ride. And if you look at that October print, you can see it just edging up higher again over August high at 2.5% year on year. Now, if we see that continue its trend lower, that's really going to give markets the confidence that the inflation battle is truly being won. The last thing the market wants to see is this sort of, ticking higher back up towards 2.93. That will start to get hairs running, and that will really start to price out the chance of a December rate cut if we see anything sort of like that. So it's a good event for us to look at, should give us some good volatility in the dollar, and euro dollar will be very sensitive with all the politics going on in France and Germany. So that will be something for us to look at on Wednesday, and we'll keep you updated with the cheat sheet. Obviously, it will depend a little bit on the non-farm payroll print, and given that I've done this report before the non-farm payroll print, I will put the latest analysis on the cheat sheet. So just check for that. But either way, it's likely to be a market moving event. So certainly not one to miss. On Thursday, we've got two interest rate decisions, both of interest. We've got the SNB and the ECB interest rate meeting. Now, with the Swiss National Bank, they are in a situation where the inflation battle is, really well and truly being won. You can see, look, year on year, it's 0.7%. So it's below a 2% target. And the SNB are on course to cut by 50 basis points on their next interest rate decision on December 12th. That's the base case. And the thing with Switzerland is that they've got a big export economy. And the majority of their exports are here, pearls, precious stones, metals, coins, 30%. A huge amount of gold gets processed and refined through Switzerland as well. And a lot of pharmaceutical products are exported. Now, all those exports, and look, that's not to mention the clocks and the watches. We all know about Swiss watches. Some of the most beautiful timepieces in the world come out of Switzerland. And those exports will be hindered by a strong currency. So the Swiss National Bank has a problem, is that when markets are worried, they buy the Swiss franc. And there's been a lot of reason for worry. The Swiss franc's been accumulating sort of steadily, since 2008. And that makes it difficult for Swiss exporters because their strong currency means their products are more expensive overseas. Okay, so the Swiss try to fight that strong currency. One of the ways they can do it is by negative interest rates. So what we're looking for here out of Switzerland is how serious are they moving towards negative interest rates. That year on year, the latest November print, that was below the 0.8% expected. So inflation is falling lower. So what I'm looking for is, do they start moving towards negative interest rates? Could see a bit of a flush lower in the Swiss franc if they start being more serious on that. And obviously, if they only hike by 25 basis points, you should see a little bit of upside in the Swiss franc on that as well. But just bear in mind there's pressure that the Swiss have got, and they know it only too well. And that's the pressure that's on them to try to weaken the Swiss franc. Also got ECB rate meeting on the same day. That's one for us to cover. A lot of politics going on at the moment with a vote of confidence recently being held for France. Germany's got snap elections coming up, potentially early elections anyway, for 2025, most likely. All of that is just putting pressure on the euro, and we want to see how the ECB are thinking about their rate path ahead. That'll be one for the cheat sheet. Make sure you stay on top of that, and we'll be looking at that near the time. Now, the next and final data point is the UK GDP print. Now, inflation data does remain key for the Bank of England, and the latest CPI print was hot, with the headline coming in at 2.3% year on year, and services were at 5% year on year. Now, when you consider the Bank of England, want inflation to be at 2%, services inflation at 5% is not compatible with the 2% target. So, bottom line, Bank of England are saying their inflation metrics, although they're down from the highs we've been seeing recently, are still not in line where they want to be. So inflation is still a major driver for the Bank of England policy, particularly services inflation. Lots of Bank of England speakers keep talking about it. And stir markets see an 88% chance of a Bank of England hold on December the 19th. But GDP dipping lower is the sort of thing that could get the Bank of England's attention that they need to move towards cutting interest rates. Interest rates are still relatively high in the UK, and the Bank of England has refrained and held back from signalling sequential interest rate cuts, and that has been keeping the pound sort of pretty, resilient. So if you look at the Bank of England's projections for 2024, their last interest rate meeting, they changed the projections for growth down to 1% from 1.25%. So Q3 GDP was 1%, which was and is in line with their latest projections. And the 2025 projection is a little bit higher at 1.5%, up from the prior of 1%. So if we see GDP surprising significantly to the downside, then that's the sort of thing that you could see a little bit of pound selling around the margins, because anticipation will grow that the Bank of England will have to start moving towards interest rate cuts. But remember, moves are going to be more limited because it's inflation data that's really getting their attention. Nevertheless, still worth covering. UK GDP, it's one not to miss. You can see a decent flush lower in the pound on lower than expected readings. So that's the main things that we're looking at for this week. They're the top 3 events. Look out for the cheat sheet. We'll keep you updated, and I hope you have a very good trading week.